Hey there, and welcome to Costa Doing Business, the podcast where faith, finance, family, and freedom intersect. Here we break down the big ideas in finance, investing, and wealth building so you can make smarter decisions with your money. I'm your host, Bob, and today we're diving deeper into a topic that sounds intimidating but actually is surprisingly powerful once you understand it. We're continuing our conversation on stock options. Last time we covered what options were, the basics of calls and puts, and we talked about one strategy called a straddle. But before I begin, here's the legal stuff. The content presented in this podcast is intended for informational and educational purposes only. It does not constitute investment advice, financial guidance, or a recommendation to buy or sell any securities or financial instruments. Listeners are encouraged to conduct their own research and consult with your financial advisor before making any investment decisions. All right, my friends, welcome to today's deep dive into stock options trading. We learned last time that options are powerful. They give you control over 100 shares with just one contract, and the volatility makes them exciting. But remember, complexity is high, precision is everything. So let's dive in. To trade options like a pro, you need to master 6 critical elements. They are as follows. First, market direction. Is the index likely to rise or to fall on this particular stock? Your strategy depends on it. Second, stock selection. Not every stock follows the index that it is in, so choose wisely. Third, cycles. Every stock has highs and lows. Timing matters. And fourth, expiration date. Pick the right one because it can make or break your trade. I recently, and again, any specific examples that we give are for informational and educational purposes only. I recently, about 2 months ago, was bullish on Oracle. So I went deep into Oracle calls. And in the first couple days of that trade, my suspicions and my analysis seemed correct. I was up huge. And then government shutdown. And in addition to government shutdown, some other market conditions that just pounded my Oracle calls. And unfortunately, I still think that they could climb back over time, but because I put a 45-day expiration on those calls, they expired worthless, and I had 20 of them. Ouch. So expiration date can make or break your trade. And fifth, the strength of the movement. Direction is not enough. You have to be able to estimate how far and how fast this stock is likely to move in either direction. And finally, integration. Combine all these variables together: direction, stock cycle, expiration, strike, and that's how you build a confident plan. Now let's talk about some seller strategies. Last time we talked about calls and puts, which are really what we refer to as whale strategies, because this is how whales, which is big traders, accumulate control over large numbers of stocks. We talked about covered calls, naked puts, and these are the pillars of consistent success. They generate steady returns. With managed risk, they compound beautifully. The more capital you have, the greater your profit potential. But what if you don't have a significant amount of capital? For instance, if you sold a naked put, naked not meaning something perverse or scandalous, naked meaning you don't own the underlying stock, you would have to have the funds in the case of a naked put to purchase the stock if the stock price went down below your strike price. If the put expires below your strike price, you are going to own those shares at that strike price. So let's take a high-value blue chip type stock like Tesla. And again, this is for illustration purposes only. Tesla was trading yesterday at $391.09 per share. So to sell a naked put, one naked put on Tesla, you would need approximately $40,000 in your account just to make this single options trade. And even though you're not spending $40,000 to enter the trade, as a matter of fact, you're collecting a premium until the expiration date. Again, at the expiration date, if Tesla was below your strike price, you would have to buy 100 shares of Tesla at that strike price. And so stock brokerage firms or trading platforms will not let you trade naked puts if you don't have the total amount of the purchase price in your balance or in reserve, basically. So to resolve this problem, let's look at options combination strategies, which are otherwise known as spreads. And let's look at a very popular one that I like called the bull call spread or the vertical spread. In today's market, we need something practical, simple, and that doesn't require a lot of capital. Enter the bull call or vertical spread. This strategy uses two option contracts, one bought and one sold. Same expiration, different strikes, and because of that, it lowers your cost and manages risk. Think of it as armor protecting your single leg option, like a call or a put. For example, let's say a stock is trading at $122.50 a share. And let's say I'm bullish on that stock, meaning I think it's going to go up, but I want to control the risk in my investment. So what I could do is I buy 5 calls at $125 strike price for $10.40 a piece. And this is an actual example, by the way. The cost of that call or those 5 calls is $5,200. Now you might say, wait a minute, I don't want to risk $5,200. Well, consider this. You're controlling 500 shares valued at $61,250 for less than 10% of the total investment price. In this case, $5,200. And in addition, we're going to do something to both lower your cost and also your risk. We are going to sell 5 calls on the same stock at $135, and we are going to collect a $5.90 per share credit called a premium, meaning that we are going to collect $2,950. In this way, we reduce our net cost of the transaction to $22.50. So our risk is capitalized, our total risk is capitalized at $22.50. How could we lose the $22.50? If the stock price at expiration goes down below the lower of the 2 call prices, you would lose $22.50. but that's better than losing money on a $61,000 investment. So we have capped our losses. We have also limited our profits to $5,000. And the reason we've limited our profits is because we have bought and sold a call on the same stock in a $10 range, which we call a spread. So we've limited our total profits to $5,000 minus the cost of the trade, which is $2,250, for a total potential profit of $2,750 if the stock goes up by a modest $10. We have limited our risk and defined our profits. That's called the bull call spread. Now, what if you have a bearish outlook? In other words, you don't expect the stock to go up, you expect it to go down instead. All you have to do is flip the spread. And what I mean by that is you sell a lower strike price put and you buy a higher strike price put. That's called the bear put vertical spread. So either direction the market goes on a stock, you can do a spread and limit your risk again, and you do define your profits, but you have a lower cost. You don't have to worry about the margin requirement that I talked about earlier in my naked put example, where even though you're not buying or selling the stock today, you still have to have the stock price in full in your account. So with this spread strategy, there's no margin requirement, meaning as long as you have the $2,250 in your account, you can do this transaction and control $61,000 worth of stock. You pay one commission instead of two. So you're not buying and selling the call separately. You're doing it in one transaction, so you pay one commission. It's efficient, precise, and professional. That is the bear or the bull call spread. Let me give you an actual real-life example on Netflix. So again, Netflix is only an example, not an investment recommendation. So let's apply this principle to Netflix. Netflix recently tested support at $1,080 a share, and then it bounced higher towards resistance, which was $1,280 a share. By the way, I should say that support is the floor at which buyers begin to accumulate shares, and resistance is the ceiling at which sellers tend to sell shares. If you're bullish, you're hoping that your stock will break resistance, and if you're bearish, you're hoping that the stock will break support. So in this case, let's buy a $1,160 call on Netflix. The cost is $735. At the same time, we're going to sell a $1,280 call, and we are going to collect $430. So my net cost on this spread transaction is $305. Now, there's three possible outcomes. One is that Netflix rises but stays below $12.80. I've invested less, but my profit potential is nearly the same. Number two, Netflix declines. My loss is capped at $305, not $735. And finally, the third possibility is Netflix rallies above the $12.80, but now my profits are capped but my risk was defined. So these spread positions are smart, they're structured, and they're disciplined. My friends, this is professional trading at its best. Not chasing the impossible, but targeting the probable, managing cost, defining risk, and trading with confidence. Options are not about luck. They are about discipline, structure, and clear thinking. So stay patient, stay focused, and keep your decisions grounded in logic and study. That's how you turn from a trader into a true professional. So I thank you for tuning into Cost of Doing Business today. If you found this episode to be helpful, share it with a friend, a family member, a neighbor, or just sound smart at your upcoming Thanksgiving dinner. Be sure to leave a review and follow us on rumble.com so you don't miss what is next. I wish you all a happy Thanksgiving, and until next time, I'm Bob, helping you make smarter moves with your money. Thanks for tuning in.